So you think you've found a potential commercial real estate investment. Now what? Since commercial properties are more complex than residential, determining what your potential returns will be and what you can afford to pay isn't as easy as seeing what other properties have sold for in the neighborhood. You'll actually have to determine what could be a potential comp, study the current leases or lack thereof, decide which investment strategy to use, estimate your construction and renovation costs, and get term sheets from your lenders. Once you've done all of that, you can finally analyze the numbers to figure out if the investment will make sense for you. Here's our quick guide on how to analyze commercial real estate deals. Look for comparable properties. You may feel like you've found a deal, but you need to confirm that. Comparable properties will help you verify that you're paying the right price and can also give you an idea of what you could do with the investment. Banks will also use those to determine whether or not they'll lend on the project. When reviewing comps, you want to find similarities or get close in the zoning, the size of the lot in the building, condition and year of the construction of the building, geographic location, and any unique aspects of the property. Finding commercial comps can be very tough though. Since there isn't a centralized database of commercial real estate listings, we've found our best comps from utilizing tax records, especially CRS data, brokers specialized in that geographic location or property type, and local appraisal firms. Review the offering. Now it's time to dive into the deal's numbers. If you feel like your acquisition price is within a fair market range, you need to review whether or not the deal will make money. Yes, the price may be supported by the comps, but if there are tenants with long-term, under-market leases, the deal just may not make sense. So you'll want to get any and all financial information possible on the site. Ask the owner for rent rolls, profit and loss statements, tax returns, K-1s, anything that they can and are willing to provide. You should also review each and every lease to see what terms the owner and tenant have agreed. As the incoming owner, you will be bound to those terms too, which can make or break a deal. Whether your lender requires it or not, you should also have tenants sign an estoppel. The estoppel confirms the terms presented to you in the lease or by the seller and will uncover any verbal agreements or other documents that haven't yet come to light that could totally impact the terms. Determine your investment strategy. If you're like me, you probably have a go-to real estate investing strategy. Maybe you prefer value add, long-term hold, or new construction. There are a number of different strategies out there, but that strategy will need to be tailored to this project. Once you've reviewed the financials and the leases, you may end up having to take a different direction with the property than you had originally anticipated. After determining your investment strategy, you'll definitely have a better idea of renovation needs. Construction and renovation estimates. Construction and renovation could be your biggest expense other than the acquisition. Getting these numbers right is crucial to your success. And if you don't get the numbers right on the front end, prior to purchasing the building, you may not have a large enough loan to cover the costs and finish the job. So once you've figured out your strategy, put your construction budget together. If you've handled renovations before, you may be able to just throw together a back of napkin number. Of course, you would be wise to have a contractor or 2 or 3 come out to put together an actual bid for you. Your lender will likely want to review these numbers, so it will help you with the acquisition. Gathering term sheets from lenders. Your loan costs are the final piece before fully analyzing the investment. So you'll need to meet with several lenders, present them with the deal, and receive term sheets. Each lender will have different project requirements and appetites for asset types, so it certainly pays to have multiple banking relationships. Term sheets at a minimum will typically provide loan to value or loan to cost terms, interest rates, amortization, and length of the loan. They can often go much further into detail and include other documents that they will require from you, such as a personal guarantee, collateral, etc. Analyzing the real estate investment. Now that you've gathered together every aspect of the deal, it's time to underwrite it. If you don't have any underwriting software, here's where I highly recommend that you invest in a high-quality program that suits your needs. Some investors create their own spreadsheets, or you can buy a pre-built program, such as the underwriting models that we have available for sale in the description below. Whatever gets the job done. These spreadsheets and programs will have calculations that take into account the purchase price and acquisition fees, construction and renovation costs, down payment and loan costs, rental rates and monthly income, and so much more. If done correctly, you'll be able to enter in only the few numbers above and crank out returns on investment, internal rates of return, monthly cash flow after debt service, and so much more. Of course, it never hurts to have a back of napkin formula to check if a deal potentially works, especially on the front end, but nothing competes with a full service underwriting sheet. Okay, so now that you know the basics of underwriting and what you need to gather when you're going through the process, check out this playlist here on underwriting commercial real estate investments. We'll see you there.